And the reality is there's a few issues with this, right? Because if you're finding a property that's already been renovated, you're the sucker that's paying a premium for that renovated property. The person selling it to you is actually making the money. At some point in the future, the property is just a vehicle that gets us from point A to point B. That's it. If you can see it from that lens, then you will start to look at property as to understand what can the property do for you. All of these things that I just mentioned, these are emotional preferences. Now, as property investors, emotion is going to cost us hundreds of thousands of dollars, if not millions of dollars in the long term. So we need to remove the emotion from our property investing journey and buy with strategy, buy with purpose, buy with a data-driven decision. Hey everyone, welcome back to the Smash Property Podcast. I'm Nick V. Today's episode, we're going to have a chat about what investors think they want versus what actually builds wealth. I see this all the time with new investors coming into property thinking that they want a house that looks nice, it's brand new, it's got, recently renovated fixtures and fittings, but those aren't things that really build wealth. We're going to unpack in this episode what you really should be focusing on if your goal is to ultimately build wealth in property. We're going to go through all that and more in today's episode. If you're new, welcome. My name is Nick V. I'm the founder and director of the Smash Property Investing Buyers Agency. And over the years, my partner and I have built a 10 property portfolio. And we've done so using the methods that I'm going to show you in this episode. If you get some value out of the video, appreciate a thumbs up. Consider subscribing if you want to see more content just like this. So let's get into this, because this one is this should almost be like a prerequisite for clients that want to come and work with us to watch this video, because it is important. I feel like I say this a lot in a lot of the client briefings that we go to, and like I said in the intro, most investors think that they want a nice looking house in a nice area and it's got to feel right. But none of that really matters when it comes to building wealth. Now, property, we need to think of it like a vehicle, right? The vehicle is going to get us from point A to point B. And I've said this on a few other podcasts. Point A is where we are right now. And point B is ultimately the goals that we're looking to achieve at some point in the future. The property is just a vehicle that gets us from point A to point B. That's it. If you can see it from that lens, then you will start to look at property as to understand what can the property do for you. The property's got to do something for you. It's not just buying a property and praying and hoping it grows in value. The property needs to have a purpose. It needs to have a mission. You're going to invest money in it to take you somewhere. So we need to look at it really importantly from that particular lens. Now, some of the misconceptions that what people think they want and what people think is going to help them build wealth in the long term, and I see this a lot, is I want a house that looks nice. And I fell into this trap too, right? When I first bought my first investment property, I was from Sydney and I was looking to buy in Queensland because it was all I could afford. And, Sydney's very much kind of low set brick houses, nice blocks of land for the most part, and, nice gardens. Those are kind of the nice areas in Sydney, right? But when I was looking, and I was actually working with a buyer's agent at the time, because I had no fucking idea about Brisbane or Queensland in general. But in Queensland, there's a lot of weatherboard properties, a lot of Queensland, style properties on piers and that sort of thing. It's just a very different type of property. And I sort of looked at, I'm like, these are fucking these are going to fall apart. I'm going to be up for so much maintenance and renovations and all that sort of thing. I just want a brick property, right? So I fell into that trap too, just thinking that brick is better. Don't get me wrong, brick is a good construction material, but it doesn't equate to it being a better investment over a weatherboard type of property. Another trap that I fell into, and a lot of new investors fall into, is looking at the property from a cosmetic point of view and going okay, if it's been recently renovated and updated, it's fresh, that's great. I'd love to live in that style of property, and it's going to make my journey stress-free. And the reality is there's a few issues with this, right? Because if you're finding a property that's already been renovated, you're the sucker that's paying a premium for that renovated property. The person selling it to you is actually making the money. So we've got to flip that narrative and be like, okay, don't we want to be the ones that make the money from the property? So with that in mind, finding a property where you can add and manufacture growth, which I often talk about, is something that you want to do yourself. So we see investors all the time They want to see the nice property. It's got to have fresh paint, new carpet, new kitchen, all that sort of stuff. And look, that might suit some investors who just kind of aren't really too fussed about building a portfolio quite quickly, and they kind of want that. So that's fine, but it's not a good way to quickly build a property portfolio, and it's definitely not a good way to build wealth in a condensed period of time. They also want to go with suburbs that they've heard of, right? Suburbs they might have heard from a friend, they might have heard it on another podcast, they might have heard it in the news, a magazine, whatever, because they feel comfortable with it. They want to go with what they know. Now, the reality is, if you are going with what you know, unless you are knowing, the data behind the suburb and all of the things that make it grow, there's a very good chance that you're going to get the suburb selection wrong. That is then going to also set you back in the long term. Another one which I had recently with a client is they want to chase proximity to capital cities. Now, I love a good capital city purchase. I always encourage investors that have the budget to go and buy into a capital city. But the reality is, if you've got $500,000 and you want to buy a freestanding house, you're not really going to get close to any capital city without buying, a really rundown type of property. And don't sleep on regional locations. If you've got $500,000 budget, which many of my clients do, we are buying some amazing deals in some amazing regional locations where we are seeing $50,000, $100,000, $150,000 in equity in the first sort of 6 to 18 months of owning the property. Now that's amazing because you use that as your deposit to go and fund the purchase of more properties if you can fund the debt levels, of course. The other one is just, I want a brand new property. I want to get the depreciation so that I can reduce my taxable income. That's what my accountant told me. I see this one a lot and it fucking kills me because I'm like, don't invest to lose money to get some of it back on tax. Guys, it makes no sense. Invest because it's going to build your wealth. Invest because it's going to get you closer to your goals. So don't just go with the new one so you can get some depreciation claims onto it. Now, all of these things that I just mentioned, these are emotional preferences. Now, as property investors, emotion is going to cost us hundreds of thousands of dollars, if not millions of dollars, right? In the long term. So we need to remove the emotion from our property investing journey and buy with strategy, buy with purpose, buy with a data-driven decision, buy with logic. All right, we've got to scrap emotion completely. So what actually builds wealth? Because this is often very overlooked and very underestimated, what actually builds wealth in time. Now, how we go about doing this is a couple of things. Number one, we need to buy the property at the right price. Now, you might be sitting there going, yeah, well, obviously, Nick, like I want to buy it as cheap as I possibly can. I get it. But listen, it's not just about buying it as cheap as you possibly can, because as cheap as you possibly can for that property, you might still be paying over comparable sale value. So what we need to look at is a couple things. And this is my sort of fundamental that I've carried through my journey and I do now for most of the clients we work with. And I say most of because everyone's got a slightly different strategy and a slightly different purpose with investing. So we want to buy the property below what it could cost to rebuild. That is, if you can get that done, which is not impossible, especially in regional locations, you are doing amazingly well. So buy it below what you could rebuild it for. The second thing is buy it below comparable sale value. And I often talk about this, the buy below market value sort of saying you hear a lot, right? If you can do that, you're doing a couple of things. You are making money on the way in. I always talk about this, like you buy the property, the day you settle, you want to have some equity there. We call that instant equity, right? Now, it might not be much. It might be 5, 10, 15 grand. But if you can get that done from day one, you are already ahead, right? So we want to buy it at the right price for that reason. Number two, if we're buying it below comparable sale value, we're sort of achieving some instant equity from day one. Now, if we've also bought in a market that is rapidly growing or a rising market, we're sort of like supercharging that growth because we bought it below what it's technically worth, right? The bank is going to, and be careful with this because a lot of people get tripped up. When you buy a property, you put the offer down, you go for unconditional approval, the bank does a valuation. Most often the bank or the valuer is going to value the property at the contract price, okay? This is where people get mixed up. Oh, I didn't buy it below market value. Like, no, hang on. When you settle on the property, there's nothing stopping you from going back to your bank or broker and saying, hey, can I get my property valued again? Some banks are going to have different policies around this, but that's when you can get the true value assessed of the property. And ideally, you've got some of that instant equity there. Now, again, every policy is different. Speak to your broker about that. You may need to wait some time in order to do that. So we bought it below market value. We've sort of given ourselves a bit of a buffer. We bought in an area that's growing in value, so we've supercharged the growth over the next sort of 6 months. And the idea being is that we want to be able to pull our deposit out within the first sort of 6 to 12 months. All right, pull our deposit out. Why? So we can go and buy again. So that is why buying the property at the right price is so critical to get right. And I often see investors want to buy in hot markets and they want to pay over asking price for the property. And they wonder why they don't have enough equity to pull out and build their portfolio again quite soon. So if you can do that, you're going to be ahead of 95% of investors without question. The second thing is we want a strong land component, right? Land appreciates, buildings depreciate. So as much land as we can really get is going to be more beneficial for us for a number of reasons. Obviously, the value of the land is going to appreciate over time. The options that we have for the actual property itself is going to allow us more flexibility later on. I'll give you an example. All the properties I bought in Brisbane that were houses, I bought with big enough block of land where I could at some point build a secondary dwelling on the property if I wanted to. Now, have I done that on a lot of them? No, not yet, but the opportunity's there. All right, I've also got opportunities with some corner blocks to knock down, rebuild a duplex on there at some point in time if I choose to do so. So buying with the future in mind and having that flexibility later down the line, really critical to get right. You've obviously got to have the right budget to fund the purchase of these properties. Because if you're talking sort of a $300,000-$400,000 purchase price, probably not going to have that flexibility. But if we're in the sort of 6 to 800K sort of purchase range, a lot of world opens up for that. And if you're only in the 3 to 400K bracket, don't trip. There are some amazing deals that you can get that I purchased for clients that are setting them up for long-term wealth. You've just got to be real with where you are on your particular journey and don't get, I guess, deflated if you've got a lower budget, because if you've got a budget to buy a property, you're doing better than most people. That is an absolute fact. We've got to buy in the markets where the demand is greater than the supply. That's just the key fundamental economics behind buying in a market that's going to rise in value. We want tight vacancy rates. We want population inflow. We want jobs increasing in the area or very low unemployment, pressure on new builds going into the area. So all of these sorts of things, we want to make sure we can kind of tick those boxes to make sure the area is good. We want to buy it well, and we want a nice block of land. So we're kind of setting ourselves up for the future. Now, the funny thing with this is, and I was chatting with a client the last couple of days, we were sort of talking about Victoria and some of the markets in Victoria being quite good and on a different stage of the cycle than, say, some of the markets in Queensland. And I was giving them an example of, like, let's say hypothetically you could go back in time and buy in a Rockhampton or a Bundaberg and buy a nice house for $200,000-$300,000. Would you do it? Absolutely you would, because you've got the hindsight of where the market is right now. Now, the example was Victoria. We're buying properties in Victoria for, 3, 4, sometimes 500,000, depending on where it is. And the example was that Victoria is on a completely different stage. My God. Victoria's on a different stage of the market cycle than Queensland. Queensland's sort of approaching the peak of the market. It's had a lot of growth. Victoria's sort of in that rising phase. So it makes sense fundamentally to get into that rising sort of phase market. Now, a lot of people, when we were buying in Queensland, were like, mate, you're a dickhead. These properties, their bubble's going to burst. You're not going to make any money out of it. I'll tell you what, all the investors that we have bought for in Queensland, for myself, clients, are absolutely laughing because they've got 50, 100, 200, sometimes $1,000 in equity that they're now able to use to go and fund the purchase of their next property if they wish to do so. The same thing now is going to happen in Victoria, maybe to a different degree because it is a slightly different market. There's a few other different factors there, but it's sort of that pre-boom phase in Victoria right now. So you've got to get the growth cycle right. And I've said it on so many podcasts recently, don't just look for the highest growth areas because often the growth has already occurred. You're buying at the top and you may not reap the as good a reward as if you bought at the bottom. So the other thing is people go, maybe I should say, is don't underestimate or misinterpret what I'm saying is that you want to buy a rundown shit property. That's absolutely not the case. What you want to make sure you do is get a building and pest inspection done, which is completely independent to the sale, right? They're not related to the sales agent. It's not a sales agent recommendation. It's someone that you found, that you verified and you trust to go through, who's actually a registered qualified builder, to check the structural integrity of the property. That is a key part of buying right. Because obviously, if it's a structural issue, doesn't mean it's a red flag. It doesn't mean, well, it is a red flag, but it doesn't mean it's a complete, no-go. You've got to work out what is the structural issue. I've bought properties with structural issues. It might have been a pier in the property or a couple of piers that might have needed replacing. It could have also been, a roof that might have needed replacing. You can get some really good deals when you do this, but you've got to know what you're doing. So that's the protection that you have as the investor to make sure that the property is actually going to stand the test of time. It's not going to collapse on you and fall apart, as you buy it. Kitchens, paints, bathrooms, all these things, they're all cosmetic. They can be fixed. Structural things, a little bit of a different story. You want to make sure you get that right from the jump. So just back to this vehicle analogy, right? You've got to think about this. Your investment property is not your home. Your investment property is not something that you are going to live in. Your investment property is your vehicle. It doesn't reflect your taste. It doesn't reflect your identity. It is a vehicle to get you from point A to point B, like I mentioned. Now, point A is your current financial position. Point B is the financial freedom or the goals that you're looking to achieve, the things that you want from property. The vehicle needs to get us there, right? Which is the most important part and what a lot of people tend to miss. Make sure the property that you're buying is getting you closer to your goals, not further away. And I'll just throw back to the brand new buy because you can get tax depreciation benefits from it. Does that get you closer to your goal, or does that push you further away in terms of building your wealth? So it's like you don't pick an Uber based on what color the Uber is. You pick the Uber because it's the quickest. It's going to get you from point A to point B. Same thing with property. You need somewhere that is going to get you there with as much speed and as much efficiency as it possibly can be, and at the right price. All right. That's the key thing we need to make sure we hit with buying the property. So property is not the goal. The goal is what property gives you. That's the most important thing. What is the property doing for you? It has to go out. It has to do something for you to better your position in the long run. So here's why buying at the right price matters more than looks. Number one, you've got to build instant equity. Buying at the right price allows you to build instant equity or get equity as quickly as we possibly can, because when we're building a portfolio, time is everything. And if we can do that as quickly as we can, the better off we're going to be. It protects you if there is any downturn in the market, so we can protect ourselves from a negative equity situation. It boosts our ability to get into property number 2 as quickly as we possibly can. Now, we've obviously got to be able to service the equity release to fund the purchase of the next property. This is a discussion you need to have with your broker. But that's how all investors do it. They don't sit there saving cash for every single purchase. They leverage the equity so they can get into the market, because smart investors understand being in the market is more important than trying to save and reduce debt. Because as I've said on many other podcasts, debt becomes irrelevant with inflation. It shortens the timeline that you are going to need to get to the goals that you want to have, right? So whether that's leave work a bit earlier, work a bit less, travel a bit more, buy more cars, buy the dream home, whatever it is, it gets us there quicker. And the best thing above all else is that it compounds faster, right? We want to compound our way into a better net wealth position. Buying at the right price rather than buying for looks allows us to do those things. So when you buy right, you instantly compress the time needed to move forward from the investment into the goals that you want to have. That's the whole game. That's it. So we need to focus on the goal, the outcome, which is why I say for a lot of clients, like I always ask the question when people come and work with us, it's like the first thing I want to know is, okay, why are we doing all this, right? We're going to go through a hell of a journey, right? That's going to be taxing mentally, physically, maybe not physically, maybe physically, depending on if you can sleep at night. It's going to be financially draining. Why are we going to go through all this bullshit? There's got to be a reason for it, and you need to know why. And I don't take the generic, I want 100K passive income, I want 200K, I want to leave my job early. Nah, what are you going to do with that money? What are you going to do when you leave work? Because that's the real emotional driver that you need to carry you through all the bullshit that you're going to have to go through. So the other thing I see, new investors want to tick every single box from day one. Every single box. They want high growth. They want high yield. They want to get a dual income property. They want development potential. They want a, brand new, perfect presentation, owner occupier appeal, capital city, all this sorts of stuff. It's like they go through this ChatGPT checklist of what a good investment really looks like. And I'll give you my personal story, right? Like Akira and I were at 10 properties, and it's only now that we're starting to look at dual income properties. It's only now we're looking at commercial investment plays. It's only now we're looking at high yield plays, because the first foundation of your portfolio really has to be built on high growth properties. If your goal really is to build wealth in the long term, right? Cash flow play from day one wouldn't get me to 10 properties. Cash flow plays are great when you have growth behind you, right? If we did cash flow play from day one, the problem with that is, yeah, cool, I might have $100 a week net positive cash flow and I'll pay a bit of tax on that. I might have, $50, whatever after it, depending on my income. I'm then going to have to save for the next property, right? And that's going to take me fucking years to do it. Whereas if I did what I did and I bought a growth property, extracted the equity, it's a year later I can buy the next property, and 6 months later I can buy the next property. So we condense that acquisition phase into as short a time span as we possibly can. Cash flow plays don't get us there. It's a bit of a pet peeve of mine, because I see this all the time. People are like, I want positive cash flow. And it's like, okay, cool. This is your first property? Great. What's the positive cash flow going to do for you right now? Because again, going back to the vehicle, it's like that positive cash flow getting you from A to B is going to be like a snail. You know what I mean? It's just going to sit there slowly. It's going to take you fucking 40 years, 50 years to get to, a position that you actually want to be in. So it's growth first, cash flow second, options down the line after that. So people think they want a nice looking house, but what they actually want is equity. What they actually want is growth. What they actually want is a better borrowing power. What they want is freedom and choices and the ability to get to their goals sooner. That is ultimately what any investor really wants. It doesn't matter what goals you have, those are the things that we need to break down and focus on. So property is just the tool. The real goal is the life that you're building on the other side of it, right? So if you want more help finding the right property that matches you and your goals, this is what the team and I do with absolute precision, week in and week out. We use the methods that I've used personally, Akira and I've used personally to build our 10 property portfolio. We've used methods that we have done and walked the walk of. And if you want to walk down that path where you can leave a job that you don't like, maybe start something, a business that you're passionate about, maybe live in an area that you want to live, have maybe the nice cars or whatever it is that you want, that's the path that Akira and I have taken, and that's the path that we're on, and it's a journey, right? There's never an ending thing, right? We're going into a new phase of our property portfolio, like I mentioned previously, where we now go from having those 10 sort of solid foundational portfolio to now starting to move into some of these more exotic styles of investment. So if you want a hand from someone who's done what you're looking to achieve, this is what we do. There's a link in the description if you're on YouTube to book a time to have a chat with us. We don't work with everyone. We are a specific investment property buyer's agent only. And even that, not every investor is going to fit the, what we do. So it's best if we chat first. It doesn't cost you anything. It's a quick 10-minute chat. The link is in the description. With that, if you have any topics that you want us to cover on future episodes, leave them in the comments below. Let me know what you think about this one as well. Also, follow us on social media at Smash Property Investing. We're on all of the socials. I think Instagram is our most I'm most active on Instagram, really. I know I should be on all the other ones. Oh, LinkedIn too, actually. I don't sleep on LinkedIn. I'm posting stuff there too. So follow me there. That's all we have time for today's episode. I appreciate you watching and getting this far. Until next time, thanks for watching. I'm Nick V. Catch you soon.